And welcome back to Investment Banking University's Front Office Investment Banking Process course. We're talking about the next step in the front office investment banking process, which is known as underwriting, and the underwriting process is what we're going to be talking about. So, of course, we're going to start out with the table of contents here. We always begin each subsection in the course reviewing where we're at in the front office investment banking process, and we're going to see that in the first slide here. So we're going to talk about why underwriting, the underwriting process, and then going in step by step, talking about gathering historical financials, finding adjusted EBITDA, building the financial statement model, the valuation football field, and ultimately customizing the financial statement model for specific types of transactions. So just to review, the front office investment banking process is, of course, what we talked about in the first presentation, starting out with coverage, going into mandate target matching, origination, fee structuring and winning the mandate, underwriting, packaging, buyer list creation and process there, deal structuring, and the M&A process. So why are we talking about underwriting in the first place? So after we actually win the mandate and we collect the historical financials, which is a part of this, underwriting aids us in understanding the intrinsic value of the target company. And it aids us in pricing the company under various scenarios. In terms of the underwriting process, we're going to be talking about gathering the historical financials, finding adjusted EBITDA, building the financial statement model, building the valuation football field, and customizing the financial statement model for specific types of transactions. So in the SMB, lower middle market, we are really going to be using as kind of a back of the napkin type valuation, finding adjusted EBITDA and then applying a multiple to it to really gauge a high level understanding of valuation. So after receiving the financials for the target, the investment banker must calculate the adjusted EBITDA. EBITDA and total owner's benefit are proxies for cash flow, but not true cash flow for the businesses. There will be CapEx and working capital deducted to get to true cash flow. Total owner's benefit adds back taxes, interest, depreciation, and owner's benefit. In terms of gathering historical financials, once the M&A mandate is won, it's important to actually underwrite the financial product, the acquisition or the buying and selling of a company, by building a financial statement model and valuation on top of it. In order to underwrite the financial product, one needs to gather historical financials, and this typically means trailing 3 years at a minimum, and ideally last 5 years. In terms of building the financial statement model, once we have historical financials, we can then build the financial statement model, which will then be the basis for modeling various scenarios, ultimately driving valuation. So using the financial statement model, going back a few years, we're then going to be able to project into the future, get an understanding of the valuation, and ultimately be able to position the sale accordingly based upon the valuation that we derive. So ultimately, after building out that financial statement model, we can then go about performing a valuation analysis. And so after arriving at an adjusted EBITDA, the investment banker will determine the public comps and extrapolate a multiple for the target company, adjusting for size of the company. From there, precedent transactions will be spread to determine the mean multiple. Finding the midpoint of the valuation methodologies can be used to determine the valuation, but the range is often communicated to the client or potential buyers. In terms of the next step, when we're getting into thinking about likely buyers for a company, we're going to need to adjust the financial statement model for various and specific types of transactions, whether it's a strategic or a financial buyer. There's going to be a different understanding maybe on the synergies for a strategic buyer and other sorts of considerations with regard to a financial buyer that we need to incorporate in these models. So after building out the financial statement model, we can build the transaction-specific model related to particular buyers that have expressed or may potentially be interested in. So this is what we just talked about here, just touching on it at a high level, which is going to be the underwriting process, starting out with gathering financials, finding adjusted EBITDA, building in the financial statement model, building the valuation football field, and then customizing the specific model or the financial statement model for specific types of transactions related to the individual buyer. So this is, of course, the underwriting process. It is a part of the front office investment banking process. Go to investmentbankingu.com. Go ahead and register for the course. We're going to be driving into a greater detail and touching on each one of these topics. Thanks for your time.